Following the acquisition of Wintershall-Dea's non-Russian assets in late 2024 and the subsequent strategic pivot into the United States Gulf of Mexico via the LLL exploration acquisition in early 2026, Harbour Energy has altered its risk-return characteristics. The scale of Harbour Energy's growth is anchored in a decade-long strategy of consolidation, which culminated in the 2025 fiscal year, demonstrating the full-year impact of the Wintershall-Dea integration. Production volumes have shifted from a UK-centric 186 kboepd in 2023 to a diversified pro forma rate approaching 500 kboepd by the end of 2025. This expansion has not merely been a function of volume, but of a deliberate shift toward lower-cost, higher-margin barrels in jurisdictions with more predictable fiscal regimes than the UK North Sea. In 2025, production averaged 474 kboepd, representing an 84% increase over 2024. The reliability of this production base was underscored by an operating efficiency of 93% across the expanded global portfolio during the first half of 2025.
Key production highlights. Group production, 474 kboepd in 2025, with a 2026 year-end target rate approaching 500 kboepd. Norway contribution, a forward target of over 175 kboepd. UK contribution, a 2026 target range of 145 to 155 kboepd. Argentina contribution, growth expectations to over 80 kboepd following the Phoenix project completion. Liquids gas mix. In 2025, production was split into 40% liquids, 40% European gas, and 20% other gas. The 2026 targets aim for a slight shift to 42% liquids and 38% European gas. The unit operating cost trajectory further illustrates the benefits of scale. Unit costs fell from $19 per BOE in the first half of 2024 to $13 per BOE for the full year 2025. This 30% reduction was driven by the absorption of lower-cost Norwegian and Argentine assets, which still led to higher unit costs associated with aging UK North Sea infrastructure. Management has signaled that unit costs should remain below $15 per BOE through 2027, even with the addition of the capital-heavy U.S. Gulf of Mexico operations.
The announcement in December 2025 of the $3.2 billion acquisition of LLO Exploration Company signifies a major pivot for Harbour Energy. By entering the U.S. Gulf of Mexico, the company is accessing a region that combines high-margin oil production with a sophisticated infrastructure network and a highly favorable tax environment relative to the North Sea. LLO is recognized as one of the premier privately held operators in the deepwater Gulf of Mexico. The acquisition includes an oil-weighted portfolio with long reserve life and an operating cost structure estimated at approximately $12 per BOE. This is particularly relevant for Harbour Energy, as it introduces a new center of technical excellence. The Gulf of Mexico assets are expected to be free cash flow per share accretive from 2027 onwards, providing a significant tailwind to the group's long-term distribution capacity. The Gulf of Mexico entry is not merely about production, but about acquiring an experienced team with a proven track record of deep-water exploration and development. This technical capability can be exported to other areas of Harbour's portfolio, such as the Zama and Can developments in Mexico, where deep-water expertise is critical for maximizing recovery and managing complex capital projects.
The $3.2 billion consideration comprises $2.7 billion in cash and debt and $0.5 billion in Harbour's voting ordinary shares. To fund the cash component, the company secured a $1 billion term loan and a $1 billion bridge facility. While this deal improves the business risk profile by increasing reserve life to approximately 8 years and diversifying production, it has introduced near-term leverage concerns. S&P Global Ratings placed Harbour Energy on credit watch with negative implications following the announcement, noting that adjusted leverage could spike toward 1.0x to 1.1x in 2026, exceeding the company's conservative through-cycle target of less than 1.0x. The speed of deleveraging through 2026 and 2027 will be a critical metric for maintaining the company's investment-grade credit rating. Financial leverage. Net debt totaled $4.2 billion at year-end 2025. Following the LLOG Exploration Company acquisition, debt is projected to range between $5.5 and $6 billion in 2026. Leverage, net debt/EBITDAX, was 0.7x in 2024 and 0.6x in 2025, with an expected increase to 1.0 to 1.1x during the 2026 integration phase.
EBITDA grew from $4.0 billion in 2024 to $7.1 billion in 2025, with a 2026 outlook of $7.0 billion to $7.5 billion. Credit status. Harbour held a Baa2/BBB- investment grade rating through 2025, which S&P placed on credit watch negative in 2026, pending the LLOG closing. The Harbour Energy portfolio is structured around 4 core hubs: Norway, the United Kingdom, Argentina, and Mexico. Each region plays a distinct role in the company's financial and operational strategy. Norway has emerged as the company's most reliable growth engine, characterized by low emissions intensity and high operational reliability. The Wintershall Dea acquisition brought 165 kBOE PD of Norwegian production, which increased to 173 kBOE PD in early 2025. Key projects in the Norwegian sector include the Maria Phase 2 development, which saw its fourth and final well come online in late 2025, and the Dvalin North project, which is on track for a mid-2026 startup. These developments are crucial for offsetting the natural decline of older fields and maintaining Norway's status as a high-margin hub. Furthermore, the award of 9 exploration licenses in the APA 2025 round, 4 as operator, ensures that the company maintains a robust pipeline of near-infrastructure exploration opportunities. Argentina represents the largest concentration of the company's 2C resources, primarily within the unconventional Vaca Muerta play. With approximately 600 MMBOE net resources in Vaca Muerta, the upside is substantial, though the monetization of these resources requires significant infrastructure investment. The Southern Energy FLNG project is the centerpiece of the Argentine growth strategy. Harbour holds a 15% interest in this 2-vessel, 6 MTPA LNG project, which reached a final investment decision in 2025. The project is on track for a late 2027 startup and has secured all necessary environmental licenses and export permits under the government's RIGI incentive framework. This development is transformative for Argentina's gas sector, as it allows for the conversion of domestic gas into a global export commodity, bypassing the limitations of local market demand and price caps. In Mexico, Harbour Energy is focused on converting 2 major discoveries, Zama and Kan, into producing assets. The operatorship of the Zama field, 750 MMBOE gross, was transferred from Pemex to Harbour in early 2026, marking a significant milestone in the field's development. A more capital-efficient, phased development plan has been submitted to regulators, which prioritizes early cash flow over massive initial capital outlays.
The Kan discovery in Block 30 has also seen significant progress. Following an appraisal program that resulted in a 50% upgrade to resource estimates to 150 million MBOE gross, the company is maturing FPSO options with front-end engineering design targeted for 2026. The UK North Sea continues to be a major production hub, with assets like J Area and the Greater Britannia area performing strongly. In late 2025, J Area reached production rates not seen since 2013, driven by new wells coming online. However, the investment climate in the UK has been marred by successive changes to the Energy Profits Levy. Harbour Energy has responded by significantly reducing its UK capital expenditure, focusing instead on converting reserves to production and decommissioning activities. The acquisition of Waldorf Energy Partners UK subsidiaries for $170 million in early 2026 is a strategic move to optimize the company's tax position. This acquisition releases approximately $350 million in trapped cash and provides $900 million in tax-affected UK tax losses, which will be instrumental in offsetting future EPL liabilities. The financial policy of Harbour Energy is centered on maintaining an investment-grade balance sheet while prioritizing sustainable shareholder distributions. The company's ability to generate material free cash flow is the primary driver of its valuation. In 2025, FCF reached $1.1 billion, a significant increase from the $0.1 billion reported in 2024, which was impacted by one-off acquisition costs and working capital movements. The company pays an annual dividend of $455 million, $380 million to ordinary shareholders, and $75 million to non-voting shareholders. In 2025, this was supplemented by a $100 million share buyback, bringing the total payout to approximately 55% of free cash flow. Looking ahead, the company aims to transition to a payout ratio-based dividend model in 2026, aligning it with international peers and providing potential for increased returns as the LLOG acquisition begins to contribute to FCF in 2027. To protect its cash flow and support its capital investment program, Harbour Energy maintains an active hedging strategy. This is particularly important for its European gas exposure, which is subject to significant seasonal and geopolitical volatility. 2026 commodity hedging position. European natural gas. Approximately 50% of total economic exposure is hedged at an average price range of $11 to $11.4 per MSCF. Brent crude oil. Between 35% and 40% of economic exposure is hedged at an average price of $71 to $72 per barrel.
These hedges provide a floor for revenue and ensure that the company can meet its debt obligations and dividend commitments even in a lower commodity price environment. Management has indicated that a $5 per barrel change in Brent oil prices or a $1 per MSCF change in European gas prices impacts full-year free cash flow by approximately $150 million. Total capital expenditure for 2025 was $2.3 billion, slightly lower than original guidance due to reduced activity in the UK and the phasing of Norwegian spend. For 2026, CapEx is expected to decrease to between $1.7 and $1.9 billion. This reduction reflects the company's strategy of high-grading its portfolio, focusing investment on projects with an internal rate of return, IRR, greater than 20% and break-even prices below $40 per barrel or $5 per MSCF. The ability to maintain a flexible capital program is a key strength. Harbour's mid-term portfolio optionality allows it to defer or accelerate projects in Mexico and Argentina based on prevailing market conditions and balance sheet strength, providing a vital buffer during the 2026 deleveraging phase.
Harbour Energy's valuation is often analyzed in comparison to its UK-listed peers and international independents. Despite its rapid growth and diversification, the stock trades at a discount to its cash flow potential, reflecting the market's caution over its UK exposure and the leverage impact of the LLOG deal. Comparative peer valuation and benchmarking metrics. Harbour Energy trades at 1.7x EV/EBITDA LTM and a PE ratio LTM of negative 7.7x, reflecting statutory losses. Ithaca Energy trades at 2.7x EV/EBITDA LTM and a negative 23.4x PE ratio. Energean trades at 5.7x EV/EBITDA LTM and a 19.2x PE ratio. Serica Energy trades at 4.2x EV/EBITDA LTM and a negative 25.7x PE ratio. Harbour's EV/EBITDA of 1.7x is one of the lowest among its peers, suggesting a valuation disconnect. While the company reported a statutory loss after tax in 2024 and early 2025, largely due to non-cash accounting charges related to the UK tax regime and foreign exchange losses, its cash flow performance has remained robust. The recent downgrade by Goldman Sachs to sell in February 2026 serves as the primary bear signal in the market. Goldman's thesis centers on the expected leverage spike following the LLOG acquisition and the capital-heavy nature of 2026, which may limit free cash flow and dividend growth until 2027. Conversely, analysts from Jefferies and JP Morgan maintain buy or overweight ratings, focusing on the long-term accretion of the U.S. entry and the company's ability to deleverage rapidly.
The bull case for Harbour Energy is built on the premise that the company is currently undervalued due to a transient period of higher leverage and a misunderstanding of its ability to mitigate UK fiscal risks. By 2026, Harbour Energy will have diversified its production base, such that the United Kingdom, once its sole hub, will account for less than 30% of its output. The entry into the U.S. Gulf of Mexico and the expansion in Norway and Argentina provide a natural risk arbitrage against UK tax increases. The Waldorf acquisition further demonstrates management's ability to use corporate M&A to neutralize fiscal headwinds. The current valuation does not appear to fully account for the free cash flow inflection expected in 2027. Once the LLOG acquisition is integrated and the heavy capital spend of 2026 is completed, the company will have a massive oil-weighted cash generation engine. The transition to a payout ratio dividend model will likely result in significantly higher total shareholder returns than the current $455 million base dividend. The Vaca Muerta and Mexico assets represent dormant value that could be unlocked through strategic partnerships or infrastructure milestones. The Southern Energy FLNG project is a clear catalyst for Argentina, while the Zama development provides long-term, high-margin oil production that is decoupled from European gas price volatility. While the market currently values Harbour primarily as an E&P, its leading position in European CCS provides a unique ESG hedge. As carbon prices in Europe remain high and governments mandate industrial decarbonization, the Viking and Greensand projects could evolve into infrastructure-like assets with regulated returns, attracting a different class of long-term utility-focused investors. The bear case centers on the execution risk inherent in a multi-jurisdictional portfolio and the potential for a prolonged commodity price slump to derail the company's financial strategy. The primary bear concern is the company's financial position following the LLOG acquisition. If Brent oil prices were to fall below $60 per barrel for an extended period in 2026, Harbour's leverage could rise above 1.5x, potentially threatening its investment-grade rating and forcing a reduction in capital investment or shareholder distributions. The company's FCF sensitivity, $150 million per $5 per barrel change in oil, makes it highly vulnerable to price shocks during this deleveraging phase.
Despite the diversification, the UK remains a significant component of the company's production and decommissioning obligations. If the UK government continues to increase the EPL or removes investment allowances entirely, the remaining UK cash flows could be severely impaired. Furthermore, the decommissioning liabilities in the North Sea, estimated in the billions, remain a long-term drag on the balance sheet that requires constant operational focus to manage. Developing major projects in Mexico and Argentina is notoriously complex. Delays at the Zama field due to regulatory disputes or technical challenges could push back first oil and erode the project's net present value, NPV. In Argentina, while the current administration is supportive of energy exports, the country's historical pattern of radical policy shifts remains a persistent risk for long-cycle projects like FLNG. The Harbour portfolio includes several mature fields that require significant maintenance to mitigate natural decline. Any unexpected underperformance, such as the issues noted at the Njord field in Norway, can impact production targets and increase unit operating costs. Maintaining a 93% operating efficiency across such a diverse and aging fleet is a major technical challenge.
The performance of Harbour Energy is inextricably linked to the fiscal policies of the countries in which it operates. The fiscal diversification of the portfolio is now as important as its geological diversification. The UK government's introduction of the Energy Profits Levy in 2022 and its subsequent extensions have created a marginal tax rate of 78% for North Sea producers. The replacement of the EPL with the Permanent Oil and Gas Price Mechanism, OGPM, in 2030 or earlier, if triggered, is intended to provide long-term clarity. However, the OGPM thresholds, $90 per barrel for oil and 90p per therm for gas, are set high enough that they may not offer meaningful relief in a standard commodity price environment. Harbour's strategy to minimize UK investment and utilize Waldorf's tax losses is a direct and necessary reaction to this regime. In contrast, Norway's fiscal regime is famously stable and transparent. While the headline tax rate for oil and gas is high, 78%, the system is designed to encourage investment through generous capital allowances and a predictable tax refund mechanism for exploration costs. This stability makes Norway the ideal anchor for Harbour's portfolio, providing the cash flow certainty needed to support more volatile growth hubs. Argentina's incentive regime for large investments, RIGI, is a critical development for Harbour. By providing tax stability, import duty exemptions, and foreign exchange certainties for projects exceeding $200 million, RIGI provides the legal framework necessary for the Southern Energy FLNG project to attract international financing. For Harbour, Argentina has moved from a high-risk exploration play to a structured growth hub.
Conclusion: Harbour Energy has completed a transformation from a regional North Sea producer to a global independent energy company with a diversified, resilient, and high-margin asset base. The integration of Wintershall Dea and the entry into the U.S. Gulf of Mexico have significantly enhanced the company's business risk profile, increased its reserve life, and lowered its overall unit cost structure. The year 2026 represents a pivotal transition. The company must successfully integrate the LLOG assets while managing a temporary spike in leverage and maintaining its ambitious capital investment program in Norway, Mexico, and Argentina. While the Goldman Sachs downgrade highlights legitimate near-term financial risks, the underlying cash flow generation potential of the company remains robust. For investors, Harbour Energy offers a value proposition. At 1.7 times EV/EBITDA, the stock is priced for a North Sea failure that management is actively engineering its way out of. The shift toward a payout ratio dividend model and the expected free cash flow inflection in 2027 provide a path to a valuation re-rating. The primary catalysts to watch in the next 12 months include the closing of the LLOG acquisition, the startup of the Dvalin North project in Norway, and the resolution of the S&P credit watch status.